Okay. Nice. All right. The stream is up. Okay. Today I have my financial markets exam in 2 days. So today's Thursday. Now I have Friday and today and Saturday morning to study. So what I plan on doing today is that for our class we have extra credit if we can finish these Python notebooks. And these Python notebooks have, I guess you could call them questions, extra credit questions for us to finish. And so I'm just gonna go through all of them today. So I have them pulled up on my phone, not my phone, my Mac I'm currently streaming on, and then I'm also going to pull them up on my computer, my desktop. But let's take a look. So this is the notebook on geometric Brownian motion. Okay. I think this is one of the ones where I need to. Okay. So use this fact. B of t is a standard Brownian motion. Then expected value of b of t plus delta t minus b of t is equal to the square root of 2 times delta t over pi. So just to be clear, b of t is the output of a standard Brownian motion process, and delta t is the amount of time that has passed, and pi, I think, is going to be the axis return of an asset that we choose to model. Or it could actually just be the number pi. So using a formula like that, Brownian motion has infinite variation. Okay, so for P0, Brownian motion with drift is a Brownian motion which the zero mean is replaced by the assumption that the increments b of t plus delta t minus b of t have mean u times delta t, where u is constant. It does not depend on t. In finance applications, the drift is related to the expected return, but it's not exactly the expected return, as we will discuss below. Brownian motion has some other interesting properties. Each realization of a Brownian motion process is a function of the continuous variable t for time, as the simple paths are continuous functions of time with probability 1. This means the simple paths have no jumps. And the Brownian motion sample path can be approximated as a discrete time process sample. For example, at equally spaced time intervals which are close together, each sample path has infinite absolute variation in the sense that the limits of b of t times n minus b of t times n minus 1 goes to infinity. Even though quadratic variation So this is what the definition of limits as infinite absolute variation. So as we take the limits of n, goes to 0, the limits of the sum from n equals 0 to n is infinity. So intuitively, infinite variation means that the point of a pencil would have to travel an infinite amount of distance on a piece of to draw the graph of a Brownian motion sample over any finite interval, even a small one. Okay, so that kind of makes sense that the way that Pete paints the picture of infinite variation is that if there was a pencil, it would have to travel an infinite amount of distance on a piece of paper to draw the graph of the Brownian motion sample path over any finite interval. Kind of how a continuous function works, right? So you have an infinite number of numbers, an infinite amount of numbers in between, let's say 0 and 1 in a continuous function, or in a continuous graph. So intuitively, okay, using expressed increment t plus t minus t, sum of independent increments over many time intervals. Okay, so I'm gonna look up what these. So this is what the normal distribution, standard normal distribution. So formula for normal distribution. My guess is so because I guess you call it the expectation is equal depends B of t plus delta t. So this is the value of the Brownian motion process after delta tm is passed, minus the value of the Brownian motion process that's just at time t. Because the expectation depends on the amount of time that has passed. So I guess you could call this delta t. There are an infinite number of possibilities for the change in time. And the changes for a change in time. So therefore, as maybe delta, if we say that delta t, the limits of delta t goes to infinity is equal to How do I do the below limits in LaTeX? Maybe that. Nope. How do I make this go below to infinity? Maybe this. So this is what overleaf is telling me to do. Oh. Huh, okay. Yeah, I don't think this is a big deal right now, but the limits as delta t goes towards infinity of the, I guess you could call it the expectation of the Brownian motion process, the increments in the Brownian motion process. Is equal to infinity. Okay, maybe I can add the number of possibilities for delta t, so delta t are infinite, and the following relationship can be established. So this is saying b of t times n, as n goes really, really, really big, then this just becomes b of t. And this just also becomes b of t as well. Okay, let's say that is what we should write for now. Okay, so I'm gonna put this in one of the actual, let's call this new notebook. So geometric Brownian motion .ipynb. So exercises. Markdown. call it 1. Brownian motion, bad model for stock prices. So I think one of the reasons why Brownian motion is a bad model for stock prices is because that with Brownian motion, our increments are normally distributed and the actual value at some specific time could approach negative. And in the real case, assets don't usually have negative prices, and so there's some inconsistency there. And also I think, okay, the volatility of a stock price is constant in dollar terms. Suppose the standard deviation is such that one standard deviation price change is $2 per day. PFT is equal $100 per share. And the daily standard deviation of $2 per day might be critically reasonable with 2% daily. One standard deviation price changes is $2 per day. PFT is equal to $100 per share. Then so if PFT is equal to $100 per share, then the daily standard deviation of $2. So this is kind of confusing. Let me mark this here. So this one is confusing. So volatility of stock price is usually the standard deviation returns. Price is constant in dollar terms. Suppose that a one standard deviation price change is $2 per day. PFT dollars might be okay. So I don't know why the volatility of stock price is constant in dollar terms, because we had defined the Brownian motion as having a variance sigma squared times delta t, or delta t should represent or sigma squared should represent some percentage, right? Not an actual dollar amount. Okay. Why is the volatility of a stock price constant in dollar terms, right? Because that doesn't make any sense. Let me say why. So the variance of is sigma squared percentage, because if we're modeling prices, then the standard deviation may not be a percentage, but just may be a price. Okay. Stock of prices is defined as sigma squared, and then we multiply that by the amount of time that has passed in our geometric Brownian motion process. So is sigma squared in units of dollars or percents? So percents meaning returns, variance of returns. Okay, yeah, that's something I can come back to. Okay, log volatility, percentage volatility, notes on time units, convexity. Okay, mean of geometric Brownian motion, example of geometric Brownian motion, mean for risky assets. Okay, when working with simulated data, it is often good to debug code by checking the correct outcome generated when you calculate the theoretically correct result in your head. In the example above, verify that a sample mean is close to the theoretical mean when the standard deviation is very small. Verify that the percentage standard deviation is close to the log standard deviation sigma, and change the problem so that data is generated monthly rather than daily. The number of years is increased from 10 to 100. Sample uses different time units for our mean and standard deviation, annually for mean, daily for standard. This is not a problem. Just one since I made in the code itself. So in this example, we're simulating 10 sample paths of stock price with daily volatility of 2% and continuously compound. So that means we're going to use e raised to some continuous compounded rate. Continuously compound expect return of 10% per year, so now with an initial stock price of $100, 250 trading days per year for 10 years. Okay, so this is the parameters that are input into our model. So number of years is equal r bar is equal to r bar per year divided by days per year daily log return for continuous compounding. R bar is equal to 1 minus 1. Mu is equal to r bar minus sigma times 0.5. Okay, so I think this is where he's actually running the geometric Brownian motion. Alright, I'm gonna take my contacts out because my eyes are starting to hurt a bit. Yeah. Okay, I'm back. Now my eyes feel a little bit better. Alright, so I have to remind myself of how this mu calculation and variance works, right? So this is geometric Brownian motion, and for our problem for self-study, we're asking about, let me see, open lectures folder. So MP dot exponent, right? So this is where they calculate mu. This is where they create the actual distribution itself. So they have a random number generator, okay? So this will create a random number generator. Creates random number generator. Then we have DZ is okay. I think this will create a standard normal distribution, data set that comes from, I guess, is sampled from a standard normal distribution. And this data set will have n rows and m columns. So we'll call this n by m data sets, where n is equal to number of turns, m is equal to number of sample paths. Right. And so this should actually be the prices themselves. So prices. Price of stock. Okay. Times DZ. So this is our kind of geometric Brownian motion process here. So think of this as simulating geometric Brownian motion using random number generator. Okay. Number of days. Okay, oh, so this is actually daily. So these are daily prices. Okay. Note that in this example, we are modeling the daily stock price, daily price of an asset. Right. So this is important. Mu is equal to. So this should be. We'll call this the drift term in the distribution. I guess we could. So Pete describes the drift term of the model. Maybe this could be a proxy for the expected return on the asset. Live streaming.
Are you actually?
Yep. On the.
You want to get in? You want me to chat?
Hey, yo, chat.
In chat, I can start saying like gay son or thought daughter in chat while I'm doing my final.
Oh, you'll be the only one.
Yeah.
You'll be the only one in there.
Dude, I've gotten into a bad habit of just everyone's with all this stuff. Just like randomly, I'll be able to be like, "Hey, yo, chat."
Yo, chat.
Do you ever do that? Or just like say like, "Hey, yo, chat."
I wish.
Like I'll be like fucking doing homework or like playing drawing. I'll be like, "That's some bullshit chat right there." You know, I gotta keep it on real. And then I'm like,
Hey, they're watching. They're watching.
And I'm like, what the fuck am I talking? Oh, I didn't tell you that at the Wizards game. So Vikram had the banner, right? He actually got on TV.
Oh, you did? Nice.
He's
Oh,
Vikram
like the
on
big
YouTube.
screen thing?
No, YouTube. He had the banner outside, and he did an interview from like WSA 9. And afterwards, some Wizards guys came to us, and or like some people at the stadium, they're like, "You can't bring that banner in," which we knew, and we were like, "Okay, sure." They said, "Put it in a locker outside. They have some lockers to rent." And we're like, "Okay, sure." We walked by, and he was like, "I'll just like put it in my jacket." And as we were walking by the lockers, someone was there waiting, like, you know, just so you guys know, the lockers are here, you know, so we're gonna like keep an eye on if you don't like put it in there and try and get in. And we're like, fuck, they've been watching. And so we went to the lockers, we were like, this is some bullshit, but whatever. And she disappeared out of sight, so we were like, okay, whatever. We were like, dude, she didn't even fucking like look. But as soon as we got out of the locker area, she came back from like the ashes and was like, so yeah, thank you guys. We can take you to the front of the line here. And we were like, they were watching the whole time. Like the whole time we walked around the stadium, they were watching. And they were like, oh, you guys are good. You don't have to go through the metal detectors. We were like, not only that, they probably got pictures, somehow found out that we don't have anything. And I was just like, dude, government knows everything, bro. I don't trust anyone anymore. They had us stalked without us knowing completely. They had us stalked completely, like, figured out no matter what. They knew we were clean. They knew who we were. They, like, watched us go around the stadium till fourth. We were like, dude, NSA is some real shit, bro.
Wait, so what was you guys had a banner? Or
Vikram made a banner.
You can't bring that in?
It was too big.
Okay. But you can bring stuff in, right?
Yeah, but it was too big.
Okay.
Because his was like, he took his bed sheet.
His bed sheet?
Yeah.
Oh, okay. Yeah, that's huge.
Oh, no, not his bed sheet, his window cover. Because the blinds at the apparently the blinds at Commons are terrible, right?
I don't know.
What, you lived there for a year?
I don't know. He probably had something else because I had actual blinds.
Okay. I gotta go for that.
All right.
I gotta finish my exam.
All right. Good luck. Good luck. You wanna go walk after?
Yes.
All right. All right. So we have the price of a stock, the daily price of a stock actually. So this is the daily price of stock. Price of an asset. Turn on the asset. I guess we call this expected daily return on the asset. Actually, ooh, this might not be. This should be the expected return call this the expectation of expected log return of geometric Brownian motion. Okay. Yeah, let's bring this in here actually. So call these more parameters. Okay, so this is the number of returns, number of daily returns in n years. Oops. Okay, so the standard deviation is very small. Okay, so in the example above, verify that the sample mean is close to the theoretical mean when the standard deviation is very small. So what's the theoretical mean, right? Okay, so this is a sigma. So sigma is the daily volatility, right? Okay. Right, okay. P0's initial price. So I think this is the expected return per year. Number of trading days per year. Okay, so number of years we want to model. continuously compounded. Okay, I guess we can R mean, so array is equal to this minus 1 is equal to 10. Okay, so this is actually how much, this is the net's return from, the net expected return from continuous compounding. Okay, so net's expected continuously compounded returns per year. And then R mean year is equal to amount of what is DPPCT? Maybe, I think these are actually returns, right? So, dot shape. Okay, run all. Nice, okay. Let's do 11, maybe 1. What if I print just 1? -1, what about P of 10? What about 30? So everything's positive. 2000. Oh, 1500. Nope. 1000. Okay, so starting from the back. Right, because I'm kind of confused on what this is, right? So I was playing around with what this is on on my desktop, but maybe I could take a look here. So let's print out the different shapes. Okay, so print, we'll call this shape. Right. So these should have the same shape, right? Because they're being divided by the same. Okay, P is not defined. I think I have to run everything then. Okay. Okay, so yeah, it's 2,499. Alright. What would the first... Okay, so what is the first element in this? And what's the first element in this list? Or I guess you could call it this, I think it's an ND array, right? So it'll be 0. I feel like these are prices. What about 1? Oh, wait. I feel like maybe if I do this, they would be the same. So 1. Oh, okay. So this is just some fancy notation. Is equal to list, call this list of returns whose elements are the list of prices whose elements are the elements are lists of prices for each asset in the day before, right? So call it's 1. Okay, so okay, I guess this gives you the row and this gives you the column. So I guess whatever this index, it's oh, you're starting from 1, I guess index 0 to -1. Okay, so let's call this yeah, maybe using these would be better, the fancy quotes. Equal to the list of prices whose elements are list prices for each asset in the current day. Okay, and then I'll create a note. So notes on syntax. So -1 is indexing. We'll call it selecting all the rows from 0 to the last row -1. Of the ND array P. function is selecting all the columns. So, right, we have, I guess you could call this star -1 is equal to the number of, okay, is equal to, we create a range from 0 to 2 and -1. Okay. So I guess this then is going to be a matrix of 2499 by 1 by n. Okay, so this will be m by n matrix of net returns. So this is the sample net returns. Times multiply. Sample mean sample annual returns. Sample average from, okay, so we'll call these the statistics. Sample average return of assets, right? Yeah, I'm surprised they're not the same, but let's see. What if we print f sample average net returns, and then we include our mean. All right, let's see what's gonna happen. We'll round them. Okay, so we'll round to the 5th decimal point, maybe. Okay. Does this have? Oh, nice. Okay. I don't like the display of how these are scientific notation. But I guess from these rounded figures, we can see there's actually a pretty big distribution of average net returns over, I think it's 10 years. So that would suggest that, okay, the sample R mean is actually quite different from, yeah, it is quite different from our actual theoretical mean. Okay. Okay, let's do some experimentation. And this is when, let's say, our theoretical mean should be we can put this in a function, I guess. So yeah, I think all this we can input into a function. So we'll call this function def simulates GBM, and we're going to take in a function, the parameters, number of years, days per year, R bar per year, P0, and sigma. Simulate GBM. Call this daily GBM. Okay. Alright, and then now we can just call our function at the end. So I think these are our parameters. Parameter processing, okay. Number of years. We have days per year. R bar per year. So P0. Oh, P0. Oh shoot. P0 and then sigma. Okay, so we have these, and this should give us the same thing, right? Yes, it does. All right, and let's now do the first problem where we have a low sigma. So let's test it out what happens with P1. Okay. And we can see our means are actually approaching. Okay, so we can have changing. Let's see this. So we have 1, and then we'll call this function again. So what we're doing here is we're just changing the daily volatility by 1%. And let's see what the difference is. So we can see here, this is with 2% daily volatility, and this is with 1% daily volatility, and we can see that the returns are actually closer to our mean of 10% per year. And I think if we change this, let's say to 0.05, I mean, I would expect it to be even closer. Yeah, so it seems like these are heading towards, let's slap this even closer, so 0.005. Oops. Right, it is almost exactly the same. And we can see that. Okay, this is not in logs. Is it in log scale? So let's say our sigma is 0.02 again. Yeah, it is. Okay, well, So if we do in log scale, then this happens. I guess this just is supposed to resemble the, so sigma, if sigma is really low, then our mu, so our mu is defined as r bar minus sigma times sigma. So then our mu is just going to resemble r bar, and it's just going to kind of resemble exponential function. And I guess how matplotlib works, it kind of scales our graph. So in this case, maybe it's not really showing up as really anything being exponentiated, but I guess usually we would see some type of curve going up. Okay. All right. So verify that the percentage standard deviation is close to the log deviation sigma. So the percentage standard deviation, I think, is just the standard deviation of the differences between the returns. So I think that would be called P of t and P of delta t. Okay, so yeah, this is our percentage standard deviation. Percentage standard deviation right here. Okay. Yeah, I don't really think we need this one. So is this going to be close to sigma? Let's take a look. 0.02, 0.02, right? And then 0.005. Okay, so it actually is. Change the problem. Alright. So I'm gonna put this all into a new notebook. And then problem for self-study. Okay. I'm gonna add the code here. This could be useful. Okay. It's gonna do some restructuring here, clean it up. Okay. Okay. So this should be Python. Alright, so I'm just gonna put this function here. Okay. Ooh, okay, so maybe I'll leave that then. Nice. Okay. reduce to 0.005 now. We'll call this show mean, show, I'm just gonna call these false, false, show STE for standard deviation, okay, show mean, and then show graph is equal to false. So I'm just gonna input these conditions, right? And for that, I'm just going to so I'm just going to add a condition here to show graph. Show graph. Right. And then also kind of want to clean up this print statement stuff. So I think I'm going to if show mean, then I'll print this stuff out. And then if show CD, then we print out this. Okay. So this should print out nothing. Nice. And then I think show mean is equal to true. So print, call this, and I'll do an F string here, and then we'll, so difference between theoretical and sample means. Theoretical, and that's expected continuously compounded returns per year, and this is our sample. Okay. The sample was going to be okay, instead of printing this out, maybe I'll just have theoretical mean, and then sample mean is equal to, call this sample mean minus theoretical mean. So this will hopefully take into the effects of broadcasting with the NumPy and the array. All right. Prints. So in this example, I lowered the amounts of the daily standard, I'll call it volatility standard deviation of returns to, I think this is, okay, so this is 1%. This will be a 0.1%, 0.05%, 0.05%. percent. I think this would be, so 1 basis point is 0.1%, so this will be 0.5. So 0.5 basis points. And printed, and it seems like the difference between the theoretical and the how do you spell theoretical? Oh man, okay. I need to look this up on my other computer. Theoretical? Okay, theoretical. I'm just messing that up. Theoretical. And sample mean is very tiny. I'll call this less than . C output. Okay. Verify that percentage standard deviation is, you can see from using the same parameters from above, the standard deviation, the percentage standard deviation is calculated. Difference between the percentage standard deviation and log standard deviation sigma is almost the same with very little error. Okay. So why is that though? Show STD true. So percentage standard deviation is equal to print difference between percent and log STD is equal to the, we'll call it dp/pc. Oh. Hey, what's good? Deviation minus. What's that? What happened?
We're just like at a stalemate.
With what?
This last problem, man.
This last problem?
Can you ask your guys in chat if they know?
Hey, yo, chat. Let's see who's in the chat real quick.
Oh, a second. Imagine it's just like 550 people. Let me see your live stream, man.
Look, I don't know how to find it on YouTube. I'm gonna be honest. If I go to view your channel.
You're streaming, yeah, live.
Oh, okay, nice, nice.
I'm on stream, and who's watching?
Yeah, live.
It's just me.
Wait, give me a second. Let me flex on
Flex on cam, flex on cam.
stream.
Okay, number of viewers, days per year. It's okay. Alright, last one. Change. Mark down. Okay, I guess we can just modify if you want to change this problem to monthly or daily. Okay, so okay, let's set this to default to 0. Non-default arguments follow default arguments. Okay, so I guess yeah, there's gonna be a lot of parameters here. All right, so I'll set the I guess we can call these flags. I'll set the flags after days per year is equal to 0 or months. Okay, I guess days per year is equal to 250. Months per year is equal to 12. Just make these defaults. Alright, okay. And yeah, we won't even need this anymore. So days per year. Okay. Right, and then we want to show mean, show SCD, show graph, and then show compute daily or compute monthly. Okay, I guess we can simulate daily. Alright, that's a better word. Is equal to false. And then simulate monthly is equal to false. Okay. So default, we're not really doing anything. Okay. Parameter processing. Okay. So I think this is where we can actually say whether or not we want to do daily. So in this case, we are going to do daily, and then if simulates monthly, then n. I guess this could be an elif, and then else rip. Okay. number of monthly returns, number of years times months per year. Ooh, is that? I feel like it's how you spell months. Alright, okay. Bye months per years. Okay, rip. Print, rip. Nice. So we simulate GBM now, and then I think we would do days per year. Ooh, we do not want days per year actually. We want to simulate daily is equal to true. Nice. So are the things the same? Show STD is equal to true. Yeah, okay, it's about the same, right? Monthly volatility, so let's crank this up to maybe, let's say 0.02 again. 0.02. Ooh, monthly volatility, so it'll be monthly, let's say we have let's say we have 5% a month. I feel like that's maybe reasonable. And, okay, then simulate monthly is equal to true. That number of years becomes 100. So let's also show the graph is equal to true, and then show the mean is equal to true. Simulate monthly is equal to true. Okay, so let's see what this looks like now. All right. So we have 100 months. Oops. Okay, so I think we could do a ternary operator. If simulate daily, else I think we should probably run this, right? Months. Let's see if this works. Okay, nice. So I think good for all the extra credit stuff here. Yeah, there is no other extra credit, so I'm gonna keep this. Now I'm gonna get some water to drink. Okay, so we have that geometric Brownian motion exercise. Now I wonder if I did these problems for self-study. Okay, maybe. Okay, so it seems like these notebooks didn't get finished. I wonder if they did, so I want to check on the websites. Not currently logged in. All right. Some hot water, some refreshing hot water. Okay, lecture notes. Which one am I looking for? The Gordon growth formula. Gordon growth formula. Okay. Yeah, this, I guess my teacher never actually finished these lecture notes, so I think what I'm going to do is I had already written some up. Okay, so problems for self-study, introduction, proof of... Okay, let's see, so old lectures, I think. Gordon growth model, let's create a new file, so call it Gordon growth exercises.ipynb. Okay. Ooh, we want this to be marked down. Capital equipment analysis. Oh, okay, so I actually have the... I think this is the actual research paper in which... I forgot his name. Ends in Gordon, that's for sure. Some Gordon professor... Henry Gordon, maybe? Not 100% sure. He was the one that ended up writing the paper about the Gordon growth formula. Okay, so now we have... Let's do markdown. Okay, suppose that dividends are paid continuously as a flow, and R bar is a continuously compounded expected return. Verify intuitively or with math the expected results of that Gordon's growth formula becomes, so the dividend at Tn over R minus G. So I would think that with Gordon's growth formula, we're taking the dot product between, I believe it's the value of our dividends at some time in the future, and then that's one vector, and then the other vector would be a vector of discount factors. So the present value of $1 and sometime in the future. In this case, it'll be using continuously compounded rates. And so we have to show that that is equal to d of Tn minus g. Okay. Or I guess this is another way to express the, okay. So this is another way to express the actual Gordon growth model, assuming that it converges to, assuming that our model actually works in the sense that the growth rate is less than the expected return. I believe that's the only condition we really need. And so mathematically, if dividends are paid continuously, then delta t converges to 0. Okay. So delta t is equal to 1 over n. Intuitively, so p of t is equal to delta t. Okay. So this is all this is saying is really that the price of our asset at I guess some arbitrary time, call it Tn, which we could say today, is equal to the dividend of our asset today divided by the expected return of the asset minus g. And intuitively, if dividends are paid continuously, the dividends can be represented as a line on a 2D axis with x equals time, y equals price. The slope of the line is g bar. And the value of any dividend is defined by t. Times y equals the value of the dividend for any time t, thus g from a graph. Oh, okay. So, right, d of Tn is, we can say, some type of regression that describes the relationship between our independent variable, which is time, in this case Tn, and the dependent variable price. Or I guess price is not a great word to say. Maybe value of dividends. Okay, so value of dividends takes time. The slope of the line is g bar. Okay. Writing Tn divided by r minus g. Okay, this, not too sure. We have all of our dividends. R minus g is maybe the risk-free rate, so we divide that by the risk-free rate. Oh, and that just becomes our perpetuity. Okay. Okay. So we have that. We have this from the following. Okay. So we have 3. Right. Times, okay, so this is what I meant by the inner product. The inner product of the dividend times the discount rate. Oh, sorry, discount factor. Okay. Cute little emoji. Alright, this makes sense. Because if r minus g is less than 0, which means that the growth rate is greater than growth rate is greater than the expected return, then the sum actually goes into infinity. And if our sum goes into infinity, then this never really resembles a price. And let's say we use this formula, or this formula. Oh man, this formula to describe the price. And if g is greater than r, then our price will be negative, which still doesn't make any sense. Okay. Oh man, where did the questions go? Oh, I think it's in here. Yeah, okay. Where did the questions go? So this one is about the Gordon growth model. And it's asking us, when modeling, is it better to work with the cap rate, the dividend yield, or its reciprocal price to dividend ratio when working with different stocks? For different values of K.
Yeah.
What is a third of 3/4? So if I say three quarters of the test is on one thing, and a third of that material is on something, what is that? So 25%.
Still doing my take-home exam. I have one more question.
You're still working on it?
I got the first part of it at least.
Nice.
So wait, BZ, are you staying up late studying?
Maybe, maybe not. Depending on- Yeah.
I wanted to stay up till 1, but it's looking like 2 or 3 might be needed, so.
Oh man, okay.
Let's run on it.
K minus G. Not too sure. Honestly, I'm not 100% sure what the answer could be here, but both formulas and they are the inverses of each other. Trying to maybe I would think maybe it depends on what we're trying to model, and in the case of Gordon's growth model, there is a just divide by k and multiply. Price to dividend ratio 1/k. I feel like the price to dividend ratio, so the cap rate is defined as R minus G. Which I would think is the risk-free rate. Okay, I guess not, because R bar is pi minus, right? Capitalization is R minus G. We can express the price of an asset today So I think it's so we could say P of Tn is equal to Dn times 1 plus bar RG, so this is the growth rates. So this is the value of our dividend. Wait. Times delta t. So this is pretty much the value of our dividend, the value of the dividend in the next period, or the next, I guess you could call it quarter, whenever dividends are paid out, divided by slash, I think it's kappa. Okay. As the dividends received in the next period divided by kappa, the capitalization rates. Kappa. Instead of, so because we need to divide by kappa in the formula of, it might be better to use the price dividend ratio to multiply. To multiply because we need to divide the kappa, that can just be multiplied to next period's dividend. So derive the formula for the present value of strips dividends, defined as d1 times dn. Okay, so I think we can start with starting from the present value of a annuity perpetuity we have. So the present value of annuity perpetuity is the price PV is equal to, I believe it's the cash flow each period. Present value of strips of dividends, so D1 times. I don't think Man, yeah, what is a strip? A strip of dividends. I'm looking at that on my computer right now. I have strips of it defined as dividends. D1. Yes, okay. Cash flow, flash, okay. Slash text, risk-free rates. Ooh, that might have been the problem. Okay. Assuming that each strip represents a constant cash flow each period. And we place the risk-free rate with the expected return of the assets. We have something along we have this. Dividend each period divided by expected. Okay. To find the strips in between some time period, we could find the value of the perpetuity today and subtract that by the value of the perpetuity in 20 years. The difference in value should be the total present value of the payments that happen between the, I'll call this T years. Delta T years. The difference in value should be the total present value of the payments that happen between call it T time interval, call it T0 plus delta T. Okay. slash frac. Alright, so we have value of the perpetuity, but we also should discount that by 1 plus the expected return raised to the delta t. Ooh, no, yeah, we want this to be here. Okay. Okay, I think that's good. So this is the present value of some type of annuity within a fixed time period. Okay. Yeah, okay, so 2 was hard, right? Because 2 is asking us to replicate all dividends, the number of shares should be bought be equal to 1. Verify this by verifying that the sum of xn is equal to 1, or what was defined. So x is defined as 1 minus g divided by times t. Okay, so I think with this, there's actually a good formula here where P defines what the actual number of shares is. And I think this paints a pretty good picture of what's going on here. So let's see. So P defined the number of shares. The number of shares of the asset bought. XN. Is the following. Oh man, okay. As the value of a dividend at some time, okay, I value some time delta t divided by the total price of the assets. Therefore, this number, I think xn represents, should represent the amount that this dividend is contributing to present value. Wait. Is it though? Yeah, it is. Present value, because it's the present value. Okay. Mathematically, it's defined as n equal to from the Gordon growth using the Gordon growth model, the sum of the dividends equal to the therefore, so if we divide the numerator so if we sum up all of the xn shares xn, we get 1. So I think mathematically, so gets sum from n to n of I think it's n to infinity, honestly, right? So it's delta t say goodnight. Oh, it's some time and passes. The nth dividend. Oop. Dividend. Ooh, divided by the total. Is exactly equal to okay, so I think this should be good then. Right. Okay, we got 2 lectures down. Linear regression. Yeah, this one's probably going to be really hard. Okay. Puzzle. I think for this I'm going to I'm going to set the notebook up, but then after this I'm gonna get some I'm gonna eat some dinner probably, and then get back to it. Linear regression. So we have IPY and B. Let's rename these to include my name, Zane. Zane. Oh, we also have the Gordon growth and the growth optimal portfolio. Okay. Self-study, portfolio theory. Strain optimization. Okay. And then real estates. Okay, there's still a lot. All right. Yeah, I think there's still a lot to go through. I'm going to probably eat for now. Submit what I have so far. So let's see. Andy Elms. Buffin. Let's Geometric Brownian motion. Okay, upload. Some investments. Proof in 400. Lectures. What was this one? Geometric Brownian motion. Sizes. Okay. I think this covered all of them, right? Self-study problem, yield to maturity, and duration. Okay. And Gordon's growth formula. Alright. Lectures, and then this one should be Gordon growth model. Smiths. Okay. Alright, so we got that. We have 1, 2, 3, 4, 5, 6 more to go. Alright. That's good for now. Probably going to, let's see. Ooh. End the stream now and then pick it back up later. Oh, can I pause? Yeah, okay. It's not letting me pause the stream, so I'm just gonna go eat now. What should I do? Okay, I'll just leave it here for now. Alright, bye. back, got some food in me. Not too much. I might get something to eat later, but yeah, doing okay right now. Gotta get some water. Alright, stream is still going. Let's see. Go to growth. Got that one done. Yes, growth optimal portfolio is the next one, right? Is that one of the assignments I have to turn in? Yeah, okay. Growth optimal portfolio is one of them too. Alright. So we have notes. Growth optimal portfolio. 6. What's this? 4? Should we get enough, right? Hmm. Mm. Oh. Alright, so I'm also gonna write some flashcards because I think reading through these notebooks is actually pretty helpful. And yeah. So the number of oh my god. In geometric Brownian motion, as number of periods m becomes really large, where will all dx how can we interpret what are the underlying forces affecting the expected as geometric as the number of periods m increases and becomes very large, the underlying forces the expected value becomes as the number of periods m increases and becomes very large, the really good expected value of the asset is the same comes from a very small portion of sample paths to bless you. Good tail of target distribution. So verify the outcomes of geometry. Right, this becomes large. Okay. Okay. Python. Yo, you got it? Let's go. Let's go. Okay, imports MP as numpy as MP. I guess we can make a function here, right? So up, down returns choice. So def is what the what does MP dot choice default simple. So I'm trying to figure out what does MP choice actually do. Okay, so we'll call these parameters. So number of number of periods. Don't know what that one is actually. So, number of sample. So, go up by, so let's say price goes up by 2, price goes down. Price goes down by 2. Price halves 50 chance. So this is we create MNK. Probably associated with the each entry. Ooh. Okay, so def simulates puzzle. So we have n M and top up. Up, down, prob. Try simulates the simulates puzzle. So we'll call this top sample paths. It's probably too much. Shit. For n in a range. Thousand. Okay, so this is just looking at the returns then. As the number of periods m becomes very large, almost all the expected value comes from various related. If a geometric motion, body motion, if there is a mean of 1, I expect to return 0. Probability of obtaining an outcome close to 0. Okay. Returns. Okay, so this is doing its puzzle of turns. Simulates the puzzle of having a investment whose expected value is positive 0.25, but the median value is 0. So returns RNG.choice will create a sample data based on the inputs up, down, array. This data set will be n by m, and each value, call it up or down, has an equal chance of being sampled. Okay. Alright, so this will calculate cumulative return for each period. Sort the cumulative returns. Ascending, and then so this will reverse the cumulative returns. Descending order. Okay. for ntop in, so we'll call it 10 p.a range 10 to 51 10. For n in, so ntop is equal to 100. So we call this the, right, so pretty much what I did was, instead of just selecting some fixed number, 10, 20, 50 or whatever, I'm just going to take the top 10% of all of the returns here. So it'll be top 10% of returns. Cumulative returns, alright. Oops. Wait, where? Semi-puzzle and M. Wait, what's print ntop 10.0. Okay, maybe I can just cast this into an int. See if this works. Nice, okay. From the top 10% of cumulative returns tends to increase as the number of periods increase. Okay, so verify that the outcomes of the geometric Brownian motion become small relative to the mean with high probability when the variance is large. So when does the variance become large? Variance should depend on variance, I guess volatility depends on the amount of time that has passed, so delta t. So I guess with this, if we just increase the number of sample paths, sorry, not sample paths, the number of periods in which our geometric Brownian motion is simulating, then that should increase the variance. So verify that the outcomes of the geometric Brownian motion become small relative to the mean with high probability. Right, so the first one, we'll just create a flag again like last time. Increase the number of periods and so call it show
You want to walk
flag.
in like 20 minutes?
Yeah, I'm done.
Okay, I just gotta take pictures. I did it.
Nice.
It took like 12 hours, but you know.
Good work.
Yeah,
That's,
it's a long time.
yeah, that's some good ass work right there.
I mean, they made it hard, I think, kind of on purpose because it was take home.
Show. What should we call it? Show returns? Outcomes of geometric Brownian motion become small relative to the mean. Show values. Okay, is equal to false. Okay. So if show frac, then we'll just do these two operations, and then elif show values, else print I. Actually, let's do this. So cumulative returns. Verify that the outcomes of geometric Brownian motion become small relative to the mean with high probability when the variance becomes large. So I'm assuming that means right stop prod. That's a numpy dot prod. Oops. Numpy prod. Actually, yeah, is this cumulative returns? I think maybe it is. 1 times 2. Oh. Yeah, I don't think it's the cumulative returns actually. Okay, yeah, this one's a bit tricky. Might come back to it, so I think this is also another exercise for self-study. Okay, 1. Trading in short positions as okay, let's first define what destabilizing banner means. Trading in a destabilizing manner just means that a trader will buy when the underlying price of an asset is going up and the underlying and sell the price of sell the asset when the price is going down. Another way that Pete defines it is the way that Pete defines it is the tendency for the trade to affect go in a similar direction as in market. Market. So, in the context of a investor with short positions, the investors. short positions. If an investor is trying to keep a fraction X being short and 1 minus X and the risk-free rates. So this is greater than 100%. The context of investor with a short position. Investor is trying to keep a fraction of X. Greater than 100% in the risk-free assets earning the risk-free rates. Then, if the underlying price of the asset goes up, So for investor who
There we are. There we are.
yeah, that's impressive. Yeah,
the,
that's a long
The hard
exam.
one. Oh yeah. I mean, it took in the end like 12 hours for me.
Yeah.
Well, just because I was writing it down, but the hard one was this one actually. In the end, this one was rough. You have to go to the preview if you want to see the actual problem. But mainly, this one wasn't that bad. Mainly this one was horrendous. I was stuck so long, and then eventually I found, because it needs to run an O of n, and I just couldn't see why, because there's a for loop here for n, right?
Yeah.
And in the middle there's a while loop where it tries to find the parent in this tree, which you would think is O of log n, right? To find in a binary tree.
O of log n?
Mm-hmm. In a
Okay.
binary tree.
Sure.
Yeah, so the whole time I was like, it has to be O of n log n, right? But because you're searching from the bottom, and because of the way that it's structured, you actually have an average runtime of like, half the time is just going to be O of 1, because you're checking in that bottom layer first, right? So
Okay.
half the time is just going to be 1, because there's going to be half the things in your bottom layer, right? And it's just going to be 1. Then it's going to be 1/4 of the things are in your next layer times 2. Then it's 1/8 times 3. And if you do that summation rather than O of log n working down, you get this, which is this sum, which actually converges to 2, which means that the amortized cost of that whole while loop is not actually log n, it's just O of 1.
Okay.
So because of that, the thing actually becomes O of n.
So finding that summation was pretty hard.
Huh?
Finding that summation and the value that it converges to.
I just I couldn't see why, because I was thinking, so it turns, basically, if one of them is all the way up there, that can only be one of them. That's what I was getting stuck on. Like, I was thinking, like, dude, this while loop can literally take, it can get up to n, even. But it can only do that once, and then the rest will basically be 1 to the point where it cancels out enough. No matter what, it'll cancel out to where the total runtime cost is 2n, And when you divide that by n, you get 2.
Okay. That's impressive. That's impressive. That's impressive. Yeah, break it down. Drop it. Drop it. Drop it. Drop it. Drop it. Drop it.
Yeah, and then they go.
God damn.
We go crazy with the Gazzani.
Whew. Okay, oh my god.
I'm gonna say that. You want some pumpkin pie for your exams that you did good on?
I'm okay. I'm okay.
I'm gonna
Thank
eat
you.
this slice and then I'll go on a walk.
Okay. Exercises for self-study. Okay, putting it all together. Shortcomings. Getting distracted now.
Hey, Josh. You want pumpkin pie? Okay. No one wants to celebrate that?
Nah. Oh my god. Exact yield curve. Approximate yield curve model. Okay. This is crazy. But let's do it. My brain is fried right now, so I'm just going to work on just copy and pasting everything. Maturity and duration. Exercises dot IPYNB. Freezing. Yield to, I'll call this time value of money, IPYNB, freezing. Exercises. Okay, so we have real estates, file. Real estate exercises using the IPYNB. Okay. I think that's it, right? Alright, we have linear regression. New file. Portfolio. Folio. Theory. Exercises that be using that IPYNB. Okay, ordinarily squares. Call the singular value decomposition. Ooh, I think, is that the same? Oh yeah. problem for self-study. Markdown. Puzzle. Okay, nice. Risk aversion, log utility, Taylor series, expansion. Log utility. Ooh, yeah, this Taylor series expansion seems like it's gonna be pretty hard. Ooh. Constrained optimization. Okay. Questions for self-study. So we have Markdown, real estates. Capitalization. Okay. Time value of money. You know, okay, the rule of 72. Okay. Rule of 72 is actually something I should probably add to my notes on my flashcards. So add what is the rule of 72? So the rule of 72 just log of 2 points.
2 minutes.
Okay. Log of 2. For 6. Suggest that approximation for doubling money is Rule 72 suggests that an approximation for doubling money, for doubling the value of investments will take time takes approximately 72 divided by percent turn per year. For example, if we have an investment that will generate 6% return per year, then the rule of 72 suggests that the take 12 years to double our initial investment. 72 divided by 6 equals 12.
Okay.
You ready? Alright. Optional annuity. Huh. Example problem for self-study. Okay. Man, there's a lot of questions in this one. All right. Markdown, okay. All right, I'm coming. I'm gonna end the stream now. It's some good work and good.